In this session, we are going to talk about global financial markets liquidity study. So, it's a kind of a survey that has been conducted, wherein the key items that I am going to touch base upon here is the key definition and the dimensions of liquidity. How do we define liquidity? What are the different ways in which the liquidity is measured? We'll look at how the liquidity is different in different financial markets. How is it in fixed income markets? How is it in equity markets? How is it in foreign exchange markets? How is it in commodity market? Or how is it even in emerging markets? So we are going to look at the liquidity in different markets, the current trends and factors which are impacting the liquidity in the various financial markets, and historically what were the trends, especially from let's say early 2000 till 2015. How has been the volume as well as the liquidity with respect to the different financial markets? We'll be looking at the numbers and the trending of volume as well as liquidity in various financial markets. And finally, a quick overall assessment of how the liquidity has been changing. First of all, we need to understand and appreciate the piece that liquidity is a multi-dimensional concept. The key or the important way of defining the liquidity is the ability to execute large transactions with limited price impact. To what extent I can get into a buy or a sell operation without impacting its price by a large extent. So the more the volume I am able to buy or sell without a drastic change in the price, that means that liquidity is high for that particular market. So whenever I say a market is highly liquid, one thing we can very much observe is the transaction costs will be very low in the market, and even my execution will be very quick. So these are all the different ways of looking at the liquidity dimension. So when I'm using immediacy, it's more and more to do with how much time it is typically taking to complete a transaction. I have to really find an equivalent match, right? Buy, sell. So there should be a matching that has to happen, and that matching is purely based on the frequency of transactions, how often I get into buying and selling process, the depth of trading, how many units are typically bought or sold. That is what defines to what extent I can find, how quickly I can find a match for my buy or sell transaction. And it is very much dependent on the number of market makers that are there for that particular security, number of market participants who are getting into the buy sell process, number of buyers, sellers, how many quotes are available for each of those securities, what is the frequency at which the transactions are executed, what is the volume of transactions per day, what is the number of units traded per day or per hour, what is the transaction size, what is the minimum amount that is either bought or sold, what is the average size of the transaction, and how many days are there where not even a single trade has got executed. All these will really determine how quickly my trade can get executed. Then the other side, which is other dimension of liquidity, talks about the depth. The more and more, when I'm saying my market is deep, I'm talking about a huge flow of the trading orders, good number of buys and sells. At any point in time, I have a very big basket of buy and sell orders. So there is a continuous interest to trade on that security either as a buyer or as a seller, which means the volume is much higher in that particular security. And even if I buy in large quantities or sell in large quantities, the price impact would be much lesser. Means the volatility should be much lesser for that particular security. That is the meaning of the depth of the particular market. And the way I measure it is trading volume. The higher is the volumes on a particular day, I see that there is a lot of depth in that particular market, right? The volume of the inventory holdings, the inventory amount of inventory the dealer is holding determines the depth, and based on the volume, number of buys and sells, to what extent the price is getting impacted. Very high impact means the depth is much lesser, and vice versa. I look at the various turnover ratios and the intraday volatility itself. All these are typical indicators of depth as well as the resilience of the market. Then the third dimension which we can look at from the liquidity perspective is the breadth, which talks about within the asset classes, within equity, what is the level of consistency the liquidity is distributed. Right? Within versus across. Within the equity market, what is the level of liquidity if I am looking at different stocks in the equity market? And how does that differ across the markets? The equity market versus the fixed income markets. So I am primarily looking at, again, how many of them are core equity market participants, how many of them participate in almost every market. And I am looking at the segregation of the assets based on the liquidity, and also looking at the spreads, on the run spread versus off the run spread, something which is more and more recent. What is the kind of spread that is executed, that is existing with that kind of a security, versus something that is issued long back? What is the kind of spread that is executed with that security? So the breadth is another important dimension that is really defining the liquidity of the market. The other important thing to look at is the tightness. What does it really cost to complete a transaction? If it is too costly, then I say the market is not tight. Right? If it is costing me much lesser to complete one transaction, it's an indication of the tightness of the tightness of that particular transaction or security. So it is primarily measured through bid-ask spread. So whenever I am looking at the bid-ask spreads, I can really make out whether the market is tight or it's not that tight. So which means all these four things grouped together will become a multi-dimensional stuff. And it's basically price-based, market impact-based measures will come in when I'm looking at a multi-dimensional perspective. So the price-based measures are volatility across the period, right? Let's say year over year, what has been the volatility of a particular security? How has it impacted the overall market? Looking at the liquidity risk premium that is coming up. How much is the premium that is working out towards the liquidity risk? So we look at the liquidity score, which again is primarily used for assessing the overall liquidity across the different classes. So what do we see now? Liquidity in the different financial markets. Yes, it's an agreed fact that liquidity differs in different financial markets. In equity markets it is different, whereas even the equity derivatives market it could be slightly different. So it is primarily depending on the characteristics of the underlying asset and the overall market structure. Right? Each individual asset specific, and we are also looking at overall market specific. The whole equity market per se, what is the level of liquidity that is existing. Now, in this dimension, I want to look at an order-driven market versus a quote-driven market. In order-driven market, we all know, so we know the prices at which they are willing to buy or sell the financial instrument. Right? The buyers and sellers, they are disclosing how much they are willing to buy and how much they are willing to sell at what price, and so at what price and what is the amount, what is the quantity they are willing to buy and sell. All that is clearly displayed by the buyers and sellers in order driven markets. So from the exchange perspective, the supply and demand are typically matched, and that takes care of the entire process of matching the buys with the sells. So the exchange is making sure that things are standardized. So we see equities, futures, options, whichever are the things that are traded on the exchange, short-term interest rates, commodities, they are all going with the order-driven market. So there is a lot of standardization on the contract, and even the central clearing can happen, which means the counterparty risks and all also are eliminated to a large extent. So in these kind of markets, there is a scope for good amount of liquidity, and the main driver of the liquidity in these markets is the supply and demand from various market participants, whether it is individuals, institutions, or intermediaries. But on the other side, look at the quote-driven market, which is more and more applicable for fixed income, the foreign exchange, and some commodities and derivatives, OTC based. It is purely based on the quote provided by the various market makers, someone who take both the buy side as well as the sell side, right? They give a quote for per buy as well as sell, bid and ask, and based on that the transactions are typically executed and concluded. So the party who is providing the quote, which is that intermediary or a market maker, they are bearing the risk in relation to any kind of a price movement with respect to buying and selling, right? So when there are more and more dealers, they enhance the liquidity both in terms of immediacy of execution as well as the depth of execution of in those kind of markets. And we have even a RFQ market, which is a request per quote market, which is purely the quotes are provided on request. So it's an electronic or a voice negotiation kind of process. Here the market makers are the ones who provide the liquidity, and the price quotes that are valid for a point in time where there is not continuous buying and selling interest. So that's where the volumes are much lesser, and the price quote is typically not a dynamically changing kind of a stuff. And now in this entire process, what is the role of a market maker? So they really get into buy and holding of the inventories of the financial assets, right? The banks are typically getting into buying and selling the financial assets. They commit their balance sheet and they help the investors to either enter a position or exit a position quickly. Market maker is an entity which is providing the liquidity. So temporary short-term supply-demand imbalance, more demand than the supply, market maker bridges the gap. More supply than the demand, again the market maker is bridging up the gap by taking that opposite position. So it does not prevent the long-term demand and supply. We are only looking at the short-term stuff where there is an imbalance between the demand and the supply. That is what is the primary role of market maker, and that's where we are saying market maker is trying to bring in the liquidity into the market. And now looking at the current trends and factors that are impacting global monetary conditions are just getting stabilized. Electronification is increasing lot of e-enabled kind of trading practices are taking a priority. Lot of digitalization is happening in the financial market. All these things, depending on whether they are more positive or negative, will impact the liquidity in that particular manner. Financial markets are increasing in size, and the performance of the banking sector is completely volatile. All these things are typically impacting the liquidity in the financial markets today. Now, what I would like to look at here is historically look at the different kinds of markets and see how the volume and liquidity have really emerged over the past. A few important observations before I show some kind of graphs for you. Coming to the interest rate markets or the interest rate derivatives market, one key observation, let's say looking at the numbers from 2000 to 2015, the sovereign bond markets, which are expected to be highly liquid, right, which are least risky kind of markets, they got badly affected by small periods of volatility in the interest rates. And that is where we saw we keep seeing over the last 4-5 years, there is a decline in the depth, even for the interest rate markets, and even the immediacy is also a cause of concern over the last few years. Even coming to the breadth, that has declined. So there is overall decline in the interest rate and the interest rate derivatives market. From the dimension of liquidity, I'm not talking about the number of transactions that are happening or number of instruments that got introduced. I'm talking about the liquidity in each of the markets. Right? I could see the bifurcation across the currencies and across the cleared and non-cleared derivatives. So that's one of the prime reasons where we could see the breadth has gone down, depth has gone down, immediacy has gone down, overall the liquidity position has gone down. Look at the credit markets. Yes, the volumes have typically gone up. The number of credit instruments have typically gone up. Types of credit instruments have gone up. The volumes have typically gone up in the entire corporate credit market. Right? But, I mean, number of products have gone up. Right? Number of issuances, number of products have gone up, but the trading volumes did not go up. Number of new instruments that are issued have typically gone up, but the trading in those instruments typically did not go up, which means proportionally there is a decrease in the depth and even the immediacy. The same thing happens with the credit market. And even when you look at the credit derivatives market, average transaction sizes, I'm not talking about the total number of transactions, it's an average transaction size for the CDS products have typically fallen, which means even they are lacking the depth and immediacy. Look at the foreign exchange market, breadth is typically going down in the forward markets, and the liquidity has gone down drastically for longer dated forward market. In the shorter dated forward market, the liquidity is decently good enough, whereas in the long dated forward markets, liquidity has gone down quite drastically. So which means overall breadth in the forward markets has traditionally gone down. Look at the commodities. There is the liquidity reduced. The liquidity got reduced even in the commodity markets, because the bid-ask spreads are typically increasing. Right? We could clearly see the bid-ask spreads widening in the commodities market, which is an increase, which is a sign of liquidity getting liquidity risk increasing or liquidity getting narrower. Even the breadth is typically declining, because the market participants, the diversity in the market participants is not present. Some parties have really exited from these kind of transactions. Banks have physically exited from various kinds of commodities transaction, which is reflecting in the breadth of the market typically falling. Same lines, equities, what has been observed is the trading volumes have gone down, transaction sizes have gone down, which means they have impacted the depth and immediacy of the market. And within them, again, specifically for mid-cap equities, there was even more a worse situation. Whereas on the other side, if you look at the trading side, yes, in equity, the trading numbers have typically gone up, especially on the large cap and the indices kind of a segment, which means there is a clear bifurcation in the trading activity between the large cap versus the mid cap kind of instruments. Just a quick look at some of the things that I have covered in the earlier slide. If you look at the policy rates, they have been gradually falling. They have drastically fallen after 2009 across the world. Look at the spread of the 6-month LIBOR and Euribor. Again, there is a drastic fall compared to the previous. In some places, it has even gone to negative during the 2012-13 kind of a time frame. Now, spread of the short-term sovereign bonds over the central bank policy rate, you see there is a wide, and here there is a narrowing kind over the last 2 years. Yield on 10-year sovereign bond, the yields have fallen quite drastically. You could see a big fall in the moving averages of the yields of the sovereign bond. Trading volumes, yes, during the crisis period, the trading volumes are much higher because everyone wanted to exit. But after that, there has been a stabilization in the trading volume. But the good thing, but one important point here is the US Treasury turnovers have fallen quite drastically. Average daily trading volumes has gone down drastically after the crisis. Even you see the total repo funding has gone down after the financial crisis. Until that time, it was on an increasing path, but after that, it has gone down. And if you look at the liability structure of some of the banks, did not change that much between 2008 and 14. Right? There was a concentration of equity, a small portion. Deposits constituted significantly. Short-term borrowing slightly. Right? The deposits have slightly improved in 2014. But what we could see is other liabilities were much higher in 2008, but now they have gone slightly lesser. And look at the other things. Bid-ask spreads have gone down drastically for the UK gilt, right? Which is an indication. The bid-ask spreads going down is an indication of the depth typically increasing. And interest rate derivative contracts notional amount outstanding has marginally increased, right, with for the interest rate derivatives. But look at the interest rate swap rates. Swap rates have gone down drastically over the last 6-7 years. And yield on a 10-year corporate bonds, again during the crisis period they were at a peak, but after that again showing a kind of a gradual fall. Amount outstanding on corporate bonds, yes, slightly going up. During the 2000 up to 2010 they showed a kind of a decrease, but they started moving up, but again the numbers have not met the numbers of 2008, just before the crisis. And European corporate and sovereign bonds also are exhibiting the same. Over the last few years we see a big decline in the numbers. Investment bonds, your investment grade corporate bonds turnovers also gradually falling. Bid-ask spreads falling. And look at the derivatives also. Credit default swaps, notional amounts have drastically fallen down compared to the periods of 2007-8 during the crisis. Even the CDS spread has gone down drastically. It was at its peak during 11-12, but after that now you are seeing almost there is it has come much lower, close to that 50 basis points kind of a mark. And average CDS transaction size, There is a big fall from 2011 to 2015. Average number of trades per day also, almost for every instrument, whether it is interest rate swaps or CDS or index of CDS, currency swaps, for everything I see that 2015 numbers are lower, except for interest rate swap to some extent, where the numbers for 2015 are higher compared to that of 2013, but for all other instruments, especially all the CDS instruments, I could see that the average number of trades have fallen quite drastically compared to 2013. And even the bid-ask spreads also have drastically narrowed down. Look at the securitization part. Again, 2007-8, the securitization numbers were much higher, but they had seen a drastic fall, similar to the numbers which were in early 2000s itself. Even the forex spot transaction, there is a drastic increase, but average daily spot transactions, there is showing a kind of a gradual, a drastic decrease for across each of the currencies. Probably it's like for USDs the numbers are much higher, but at least in some of the currencies it was very pathetic kind of a situation. And look at the standard deviation, they were extremely high during the crisis, but after the crisis across the currencies, before the crisis versus after the crisis, we are typically looking at stable standard deviations coming up. And look at the forex derivatives on the OTCs, the volumes have typically gone up right from 98 to 2013. But it's actually the reverse with respect to the commodity derivatives. The volumes have gone down drastically, and volatility of the commodity prices also has been very inconsistent. During the crisis, of course, it was at its peak both for gold as well as crude oil. But now again in 2015, we are observing similar kind of a situation. Market capitalization of the global stock markets, we could see if we had seen the numbers, probably US is at peak, but there was a constant decrease compared to the previous years. Yeah, this chart is telling you that kind of a decrease. You could see that change in the trading volumes. Almost all currencies are showing a negative. Probably there is not even a single currency which is positive during the period. Even the volatilities, there are some periods where the volatility has been drastically higher. Transaction sizes, we see they have fallen quite heavily. Right, the OTC derivatives, yeah, something here, the OTC derivatives, the notional amounts, they are stable but slowly on an increasing path. But looking at the other things, emerging markets, right, emerging markets up to some point in time after the crisis, they showed some kind of a positive sign, but again, couple of years of fall. And within that also, if you see, some countries like India, they showed a slightly higher over the last 2-3 years. And whereas especially Mexico has shown, the one in yellow, after the 2008, it got badly affected, but again, it is slightly picking up to its previous scenario. And even the emerging market issuance, equity issuance, if you see, yeah, 2007 it was at its peak, and again 10 and 11 the numbers were at peak, but again there was a fall in 12 and 13, just showing some kind of improvement in 14. And volatility wise, there has been a quite drastical drop. Now, looking at all these things, what has been observed is there are 4 broad areas of weakness with respect to the liquidity. What is the difficulty in executing of the trades? Talking about the immediacy of the execution of the trades, the reduction of the market depth, volume of buys and sells, increase in the volatility Some markets became extremely volatile compared to the other. And there has been an observation regarding the bifurcation of the liquidity. Right? Some assets are more liquid, some assets have become much liquid, less liquid. So there is a kind of a reduction in the liquidity in the assets which are typically traditionally known to be more and more liquid. Now, based on whatever we have seen in the different graphs in the previous slides, what I can talk about is with respect to the difficulty of execution, number of responses each buy inquiry received. Right? How many interests or responses per a particular buy transaction they have typically gone down across investment grade bonds, high yield bonds, agency bonds. For all of them, the demands have typically gone down. Average transaction sizes in corporate bonds has typically fallen down. That has been from the report of Asian Development Bank. It clearly showed that the numbers have fallen down drastically between 2010 and 30. So there is a fragmentation of liquidity. Too many asset classes, new asset classes have come out. New trading venues have come out. New geographies have come out. Because of which there is a lot of fragmentation and liquidity, which has really caused a lot of complexity and the heavy transaction costs for the investors. The second problem that came up during in this entire understanding is the reduction in the market depth, where the dealer inventories have traditionally started falling. The higher is the inventory which the dealer was maintaining, it's an indication of high liquidity. But now the bench strength, which is typically the number of securities the dealers were maintaining in their inventories have drastically gone down. So which means the number of bid and ask quotes has traditionally fallen down. Though we see many financial market sizes have gone up, especially fixed income market has grown in size, credit market has grown in size, derivatives market has grown in size. So their issuance size is no doubt, it has gone up drastically. That is what we have seen in one of the slides. But the overall trading volumes did not happen. So there was a big thinning of the entire trading activity across each of these markets. And because the trading volumes are more and more lesser, the prices are getting badly impacted. And this is something which we are observing across asset classes, from more and more traditional government bonds kind of a market to the corporate bonds and equities. Almost all the markets are exhibiting this kind of a phenomenon. So market liquidity has gone down drastically across the markets, which is typically captured by the market depth. And looking at the other side, the third major problem is with respect to the volatility. Obviously, liquidity and volatility are highly linked. If the volatility is high, the risk of holding the inventory increases. Right? If the volatility is very high, the risk of holding the inventory typically goes up, which means the cost of providing the liquidity is again going up. So that's where the volatility and liquidity can be linked. But of course, not just that having more and more inventory, even if I don't have liquidity also, there is a possibility of high market volatility. Because if I have to sell something, I have to compromise on the price quite drastically. So what we have seen is market volatility has declined substantially after the crisis. We have seen in a lot of slides. But specifically, if I have to talk about the equity volatility, it has reduced. Right? Because the cash flow generation activity of the company, prospects, they are all stabilized. There is no, they are taking enough amount of risk mitigation measures. So these numbers have typically stabilized. But that is just after the crisis. But now again things are going back to normal. Volatility is increasing. At least in forex market, fixed income markets, we are seeing the volatility is growing over the last couple of years. And we have to understand the fact that market volatility comes with ups and downs depending on how the economy is behaving, and so you will find always a cyclical kind of a pattern. The other important problem that has been observed is the bifurcation in the liquidity, right? So the liquidity is heavily concentrated in the most liquid instruments, and it is falling in the less liquid assets. So some instruments are becoming more and more liquid, some of them are becoming less and less liquid. So smaller high yield issues, right, smaller in size, but they are high yield bonds. The liquidity has fallen quite drastically, becoming more and more illiquid. But if a large corporate bond issue is there, it is becoming more and more liquid. Even the quality issues are making a big difference. So because if the credit quality of that particular issue is much weaker, market makers are much lesser for that. So they have to provide a high yield. Because the liquidity is much lesser, high yield has to be provided. So overall cost of the credit is typically going up. And it's very, very difficult to obtain longer term forex forward contracts today. There is a decent liquidity for short term forex forward contracts, but the liquidity has drastically gone down for the long term markets. And looking at the other stuff, the issue and the liquidity, number of market participants, especially for a single name CDS, has dropped. We have seen the numbers through the slide, through the graphs. The interesting point is within the interest rate derivatives market, there is a lot of liquidity bifurcation. Geography wise, product wise, there is a lot of liquidity bifurcation. One, due to the regulatory harmonization of the trading and the clearing requirements. Coming to the equities, mid-cap equities had worst liquidity compared to the large cap equities. So these are some of the problems that we are experiencing with respect to the liquidity across the global financial markets. So just to summarize this whole step, there is a clear evidence that in the financial markets across the asset classes, the liquidities have gone down, and more specifically for the less liquid areas of the financial markets, especially the bonds, where we are talking of small and high yield, longer term forex forward contracts, there was a drastic reduction in the liquidity. And even in the interest rate derivatives market, we are seeing a drastic reduction in the liquidity. But the piteous part is even the more liquid markets, the markets that were perceived to be more and more liquid, they started experiencing a declining depth, especially the sovereign bonds and the corporate bond market. We have seen even they started experiencing a big decline in the liquidity. And this decline right now is not impairing the overall market, because on the positive side we are seeing favorable economic and monetary environment. Trading behavior started changing. All those are typically are masking the kind of an impact on the decline of the liquidity. And what we can see is this will become more and more apparent when the market is again getting stressed. So at some point in the future, all these warning signs will be taking us towards less resilient financial markets for the future. So that is what we really need to understand regarding the global financial markets liquidity from a liquidity perspective. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.